Well, welcome to the Startup Espresso. I'm Hall T. Martin, the host of the show, where we talk about raising funding for your startup and the time it takes to have an espresso. I hope you enjoy this episode. Hello, this is Hall T. Martin with the Startup Funding Espresso, your daily shot of startup funding and investing. Overall, corporate VCs invest more than traditional VCs by about 2%. Corporate VCs operate the same as traditional VCs with some exceptions. Corporate VCs seek a strategic advantage rather than a financial return. Many don't lead funding rounds, but only follow them. They bring strategic support to the startup, such as sales channels and industry partnerships. They focus on early to mid-stage companies primarily and avoid seed-stage startups. They invest based on the current strength of the corporation and don't follow the traditional raise a fund and deploy it cycle that traditional VCs do. They don't exert a substantial control over the company compared to traditional VCs, who seek a financial return in a specific time frame. And they don't look for a strong financial return as the only exit option. Corporate VCs are measured by the impact of the investment into the startup, such as number of pilots and programs rather than startup sales growth. They don't limit their investment horizon to the 10-year fund cycle as a traditional VC does, and corporate VC access deals primarily through their partnerships rather than the general market. Thank you for joining us for the Startup Funding Espresso, where we help startups and investors connect for funding. Let's go start up something today. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.